And our goal here is to create a well-diversified portfolio that offers exposure to a wide range of sectors and industries, which will help us reduce risk because then things won't be too overly concentrated in one individual company or one specific area of the market. Along with that, we also want this portfolio to be reliable and we want to make sure it performs well because we are trying to beat the market here. So we'll be choosing to invest in bigger blue chip companies that are more recognizable and for the most part have a history of outperforming the market. And because this is a dividend portfolio, we're looking to invest in companies that have a track record of making consistent dividend payments, which they're increasing every year. And many of these blue chip companies offer that, so it makes it pretty easy. Now in this portfolio, we're going to assume an initial $1,000 investment with $100 going into each individual stock. And first, we're going to take a look at the consumer staples sector, which is one of my favorite sectors to invest in. Some of the companies that make up the consumer staples sector are ones like Procter & Gamble, Coca-Cola, Pepsi, Kroger, and the Hershey Company. And as the name of the sector suggests, these companies build their business around products that are not very cyclical in nature, so they're pretty much always in demand, making this a pretty stable and reliable sector to invest in. And while I think all of these companies are great to own, I mean, I personally have Procter & Gamble and Coca-Cola. For our portfolio here, we'll choose to invest in Pepsi, who, in addition to their namesake cola, owns some other very popular beverages like Mountain Dew, Sierra Mist, Gatorade, and Tropicana. And interestingly enough, a lot of people actually don't know this about Pepsi, but they also own some of the world's most popular snack brands like Lay's, Doritos, Cheetos, Ruffles, and a whole lot more. Pepsi is just a behemoth. Anyway, in addition to Pepsi, we're also going to invest in Kroger, which is one of the leading grocery store chains here in the United States with over 2,700 stores across the country, and they operate under several banners like Fred Meyer, which is popular up in Oregon, Ralph's in Southern California, and Smith's here where I am in Las Vegas. Now, still in the realm of consumers, we're going to jump over to the discretionary sector, which is comprised of companies like McDonald's, Starbucks, Lowe's, and Home Depot, which are all fantastic companies, but are a bit more cyclical than those that we would find in the consumer staples sector. So we're likely to see more ups and downs with these companies just depending on what's happening in the market. Now, I really don't think you can go wrong with any of these companies, but historically, Lowe's has been the best performer and its dividend stats are seriously top notch. While the yield isn't the highest, they've been growing this dividend by about 20% on average every year for the last 5 years, and in general have been consistently growing the dividend for almost 6 straight decades, which makes them a dividend king. In general, there's a lot to love about Lowe's, so that's what we're going to go with in our portfolio here. Next up, we'll take a look at the technology sector where there are two very dominant companies that come to mind, and those are, you guessed it, Apple and Microsoft. Now, once again, I really don't think you can go wrong either way here because both of these companies have just obliterated the market these last 10 years, both with 4-figure returns. And I know many investors like to have either one or both of these companies in their portfolio, but for our purposes here, we're going to rock with Apple because I'm an Apple guy and that's what I have in my portfolio. Now, next up, we're going to take a look at the industrial sector, which is a really fun one because just within this sector, there are so many ways to diversify because it's made up of a ton of different industries. And because of that, there are a lot of great companies in this sector like Snap-on, Union Pacific, Deere & Company, and Waste Management. And even just out of this bunch, it's going to be hard to choose just one. But for our portfolio here, we're going to go with Waste Management, who admittedly is not the most attractively valued stock out there, but seeing as the demand for trash collection is as consistent and permanent as it can get, the company is poised to see continued growth and in general is a pretty safe and reliable one to own. Anyway, moving on now, we need a stock in the communication sector, and here we'll focus on the big two. You've got Verizon and AT&T, and over the last 10 years, their returns are pretty identical, with Verizon having a slight advantage, and in the dividend department, things are looking fairly similar as well. Both companies have pretty high dividend yields and really not much dividend growth, if any, to speak of, but the one thing that does stick out to me here is Verizon's dividend growth history, 18 years versus AT&T's 0 years of dividend growth. Now, I personally have both of these companies in my portfolio, but because we have to be picky here and we're limited to only 10 stocks, we're going to opt for the one with the higher dividend yield and the longer dividend growth history, so we're going with Verizon. Anyway, moving on, this brings us to the financial sector, where there's a couple different directions we can go. We can choose to invest in a bank like Bank of America or JP Morgan, or we can go the credit card route and invest in something like Visa or MasterCard. In some capacity, I think the decision is pretty preferential, but for our portfolio here, we're going to go with MasterCard, as it's been the top performer out of the bunch by far, and the company continues to see pretty tremendous growth. And now, guys, for the 8th stock in our portfolio, we're going to mosey on over to the healthcare sector, where there's really only one option. It's Johnson & Johnson, who is probably the most defensive and well-diversified company in the sector. Johnson & Johnson has a wide-ranging portfolio of pharmaceuticals and medical devices, and they also own popular household brands like Tylenol, Band-Aid, Motrin, and Listerine, which they'll be spinning off into a new company at some point in the near future. And now moving on, for our second to last stock, we'll head over to the energy sector, where we'll want to go with either Chevron or ExxonMobil. And historically, Chevron has been the better performer, and they have the advantage in the dividend department with a near 4% yield and 35 years years of consecutive dividend growth. Also, I may be a little biased because I do have this one in my own portfolio, but that's just what we're gonna rock with today. And now guys, this brings us to the 10th and final stock. And for that, we're gonna jump over to the real estate sector and look to none other than Realty Income, who is the monthly dividend company. Now, Realty Income has a huge portfolio of real estate consisting of over 12,000 properties, and they lease to tenants in 84 different industries, with some of their biggest and most notable tenants being companies like Dollar General, Walgreens, 7-Eleven, FedEx, Walmart, Home Depot, and Kroger, so obviously very diverse. Now, like I mentioned a moment ago, Realty Income is the monthly dividend company, so they pay a dividend every single month, but their dividend stats in general are pretty top-notch. As you can see, they have a really nice and high dividend yield sitting right at about 5%. They've been growing this thing for the last 26 years, so they've got it down to a science. And owning Realty Income is almost like a rite of passage for dividend investors. I think you'd be hard-pressed to find a dividend investor who doesn't have this in their portfolio. And with the addition of Realty Income, we now have our full portfolio right here, all 10 stocks. And over here, we can see that this portfolio is yielding 2.86%. It has a pretty nice 5-year dividend growth rate, 9.43%. And out of all 10 stocks in this portfolio, the average dividend growth history is 30 years, which is really nice. And like I said earlier in the video, guys, this portfolio of dividend stocks has generated market-beating returns. And if you would have invested in this portfolio, just these 10 stocks over the last 10 years, you would have crushed the S&P 500 by quite a bit. So here, guys, over on the portfolio visualizer, which will let us do a back test to see how this portfolio would have performed, we're looking at the time period between January 2013 and February of this year. And here you can see we've got our 10 portfolio stocks right here divvied up equally, 10% in each one. And if you would have invested $1,000 in this portfolio back in January 2013, and from there invested $100 every single week, your final balance would be $107,606, which would have crushed the S&P 500, who wouldn't even be leaving you with $90,000. So that's quite a big difference right here. Furthermore, with this portfolio, during the good times when the market is roaring, this portfolio would have generated higher returns. And on the other hand, when the sky is falling and stocks are coming down in share price, this portfolio would have experienced a lesser drawdown than the market as a whole. And we can see that over here in the best year and worst year. Your best year would have beat the S&P 500 by about 2.3%, and in your worst year, you would have seen a 10% less drawdown compared to the S&P 500. Furthermore, if we take a look at the annualized returns, on average every single year, this portfolio would have generated over 16%, whereas the S&P would be at about 12.6%. But guys, that was just the past until now, and I think we should take a look at where this portfolio might be 20, 30 years down the road if we invested into it today. And to do that, we're going to take a look at the MarketBeat.com dividend calculator using the same inputs as the previous example. An initial investment of $1,000 and $100 contributed every single week from there. And these are the same dividend stats that the portfolio is currently yielding, and we're accounting for a 7% share price appreciation in this example, and we'll look out across 30 years. Now, looking at the results, guys, it looks like by the end of the 12th year, you'd be at over $100,000 in this portfolio, and you'd be bringing in nearly $4,000 of annual dividend income. If we go down 8 more years to the end of year 20, you'd be bringing in about $12,500 of annual dividend income, and your portfolio would be valued at just over $300,000. And scrolling down even more to the end of the road, by the end of year 30, this portfolio would be yielding $50,000 of annual dividend income, and it would be valued at just over $1 million. And like I was saying throughout the video, guys, I actually have a lot of the stocks that we talked about in my own portfolio. I have Chevron, Realty Income, Johnson & Johnson, Verizon, Apple, and Lowe's.